The headlines say the dollar is slipping, but they're missing the real story. This isn't just a dip on a chart, it's a red flag waving across markets, governments, and wallets around the world. Something bigger is brewing beneath the surface. And while most analysts are still debating rate cuts, the smart money is already moving. This moment, it's not just about monetary policy, it's about power, influence, and whether the US is quietly losing its financial grip. Here's what no one's telling you, but absolutely should be. The real reason behind the dollar's dip. The dollar's dip isn't just about weak jobs data or delayed rate cuts. It's about credibility, control, and a slow unraveling of the narrative the Fed's been clinging to for months. On the surface, the story is simple. July's job numbers came in soft, inflation cooled slightly, and investors recalibrated their expectations. But beneath all that is something more fragile, the growing sense that the Fed is running out of room to maneuver. When the central bank delays a cut that everyone knows is coming, markets start to question what they're hiding, not just what they're signaling. This isn't the first time the dollar has flinched, but this time it feels different. It's not reacting to a shock, it's reacting to uncertainty. Add in political pressure from Trump's public jabs at Powell, whispers of potential board shakeups, and global markets already on edge from tariff tensions, and you've got a recipe for erosion. The dollar has always been more than just a currency, it's been a symbol of American stability, but right now it's wavering under the weight of leadership indecision and market fatigue. Investors aren't just hedging against rates, they're hedging against chaos. And while the headlines will pin it on the Fed dragging its feet, the truth is that this moment has been building for a while. Decades of dollar dominance are being tested not by a singular event, but by a shift in trust. When the world sees cracks in the system, when decisions feel political instead of strategic, the consequences ripple far beyond Wall Street. This isn't just a dip, it's a stress test. And if confidence keeps slipping, the dollar's decline could be the start of something far bigger than a currency correction. How a weaker dollar impacts your everyday expenses. When the dollar weakens, the effects ripple through your wallet faster than you might think. A softer greenback means it costs more to import goods, and that includes everything from your favorite tech gadgets to the produce in your grocery store. Even if you're not booking international trips or investing in foreign stocks, you're still paying the price. Literally. Retailers quietly adjust prices upward to compensate for higher import costs, and before you know it, you're spending more on the same everyday essentials. Travel is another area where the weaker dollar shows its teeth. That European vacation or overseas business trip just got more expensive, not because the experience changed, but because your money doesn't go as far abroad. Hotel stays, meals, transportation, all of it now demands more dollars to get the same value. And even if you're staying stateside, airlines that rely on foreign fuel or parts often pass those costs along. The result? Rising ticket prices and added fees that most travelers won't even trace back to currency shifts. Then there's inflation. While a weak dollar doesn't directly cause inflation, it adds fuel to the fire by making imports pricier, which pushes businesses to hike prices. Over time, it chips away at purchasing power, especially for lower and middle income households who feel the pinch most. You're not imagining it. Your paycheck covers less, your savings stretch thinner, and your financial margin for error gets smaller. A weaker dollar might sound like an abstract economic headline, but its impact hits hard and close to home. How this impacts US global influence. Quietly, but critically. The value of the US dollar isn't just economic, it's political power printed in green. For decades, the dollar has been the global default, the currency of oil deals, international loans, and central bank reserves. When it weakens, even slightly, that dominance gets called into question. Countries that once had no choice but to trade in dollars suddenly explore alternatives, yuan swaps, euro bonds, even crypto in rare cases. It doesn't happen overnight, but it starts with a crack in the trust. A dollar in retreat sends a quiet but unmistakable signal. The empire isn't as invincible as it once seemed. That shift has real-world consequences. The US has long used dollar supremacy to enforce sanctions, influence global markets, and steer international policy, all without firing a shot. But if foreign powers can transact outside the dollar system, that leverage disappears. Russia, China, and even some US allies are watching closely, seeing an opportunity to decouple their economies from US US oversight. The weaker the dollar becomes, the harder it is to police the global financial system, and the easier it is for rivals to redraw the economic map on their terms. At home, this erosion of influence can feel abstract, but it translates into higher borrowing costs, tighter trade negotiations, and shrinking diplomatic clout. Washington can no longer afford to assume its currency speaks for the world. In a future where the dollar is just one option among many, the US must work harder to earn trust and prove stability, not just assert it. The fall of a currency isn't loud, but the fallout reshapes power in quiet, lasting ways. The Fed's role, why delaying rate cuts might backfire. The Federal Reserve's decision to delay rate cuts may look like patience, but it's a high-stakes gamble with global consequences. By keeping interest rates elevated longer than expected, the Fed is signaling that inflation is still a threat, but in doing so, it risks suffocating an already fragile economy. Businesses holding off on investments, consumers tightening their wallets, and banks facing tighter margins all add up to a slowdown that could spiral into stagnation. The longer the Fed waits, the narrower the runway for a soft landing. Beyond US borders, the ripple effects are just as sharp. A strong dollar driven by high rates makes imports cheaper, but US exports more expensive, hurting domestic manufacturers and widening trade imbalances. Emerging markets with dollar-denominated debt also suffer, as borrowing costs soar and financial pressure mounts. What starts as a domestic inflation fight quickly becomes a global financial squeeze, with the Fed's hesitation acting as the spark. The irony, while the Fed tries to protect US households from inflation, it may be weakening their job prospects and investment returns in the process. Delaying rate cuts also plays a dangerous game with investor psychology. Wall Street has been riding a wave of optimism, pricing in future cuts, and a return to economic growth. When those expectations don't materialize, markets react, sometimes violently. The risk isn't just economic, it's emotional. One poorly timed press conference, one data point that undermines confidence, and the whole house of cards can wobble. If the Fed waits too long, the damage won't just be numbers on a chart, it'll be trust lost, opportunities missed, and recovery delayed. What investors are doing as the dollar falls. Investors are repositioning fast. As the dollar slides, we're seeing a pivot into alternative assets. Gold, crypto, emerging markets equities, foreign currencies, anything to sidestep dollar risk. It's not panic, it's tactical recalibration. Fund managers are trimming exposure to greenback-sensitive securities and shifting capital into hedges that thrive off currency weakness. The message is clear. If the dollar can't be relied on, why not bet on what rises when it falters? In fixed income, we're witnessing tactical rotation. Demand for US treasuries has cooled, while foreign debt, especially from Europe and Asia, is warming up. Investors are hunting yield outside traditional corridors, snapping up overseas government bonds and dollar-denominated sovereign debt that looks safer in a global yield shakeup. The same goes for corporate spreads. Dollar-heavy multinationals are seeing higher risk premiums, and savvy portfolio strategists are trimming US firms with significant foreign revenue exposure. But it's not just institutions hedging hard. Retail is waking up too. Crypto adoption is accelerating again, not just Bitcoin, but stablecoins pegged to foreign currencies or baskets. And growing platforms are marketing crypto's inflation hedge potential, playing directly into the fear cycle. Meanwhile, platforms like Robinhood and eToro show spike in trades and FX pairs tied to the euro, yen, and pound. In short, investors aren't waiting for the dollar to drop further. They're reshaping their entire thesis now, betting loud while others still whisper. By the time most people feel the fallout, it's already too late to react. That's the danger of a slow-moving storm like this. The dollar's weakness isn't just a financial trend, it's a signal, a shift, a warning shot. From the Fed's cautious stalling to investors racing for hedges, the writing's on the wall, trust is cracking, and the markets are listening. What comes next won't be announced with fanfare. It'll arrive quietly, relentlessly, reshaping everything we thought was stable. Stay alert. This is just the beginning.